Hi, my name's Anthony Turner. I'm one of the directors of the Small Business Institute. Today I have a guest with me. His name is Joss Milner. Who's a chartered accountant who's spent the last 20 years in the area of startups and raising capital. Joss has been involved in the successful raising of capital for a range of businesses, many of which have been IT startups. In the past year alone, Joss has helped 4 companies successfully raise money. Joss is on the board of over 8 companies, including 3 of his own successful startups. So, Joss, you've been involved in a number of successful capital raisings over the years. Tell us a little bit about your experience, if you would.
Well, it's a fascinating area, and it's pretty enjoyable working in that space because in most cases it turns out that somebody has a vision and what they really need is a little bit of money, and getting the right person with the right type of investors enables a really successful outcome. And I've seen a lot of companies go from an idea in someone's mind, a thought, right through to a successful company out there in the marketplace doing really well. And often that value's been unlocked with some money that comes from an investor.
Fabulous. So how many sort of successful capital raisings would you have been involved with?
Oh, probably about 15, thereabouts, yeah.
And all different sort of sizes, or?
Yeah, mostly on the smaller side, which is where there is so many businesses just looking for that, 100, 200, 400,000, that sort of size, right through to some reasonably big multi-million-dollar ones.
Sure. I've heard sort of ratios that within capital raising or people who invest in companies, that there's sort of a ratio of those that you can expect to be successful versus unsuccessful, and those that just sort of sit around the middle. Mm-hmm. Has that been your experience as well?
Yep. The general rules that the venture capitalists use as a rule of thumb is if they were investing in 10 companies, they would get 2 complete failures, they would get 2 massive successes, and 6 in the middle. So the way the numbers work is 1 massive success should cover effectively the investment in the other 9. So if they get a second success, they're doing pretty well.
So have your ratios remained the same in terms of the ones that you've worked with in startups?
Pleased to say there's been no failures yet. Lots of them are still in the will they make it, won't they make it phase. Yep. The danger is really that stuck in the middle. Yes. So very few companies that I've come across have raised money and then failed. In fact, none have. It's more a case of, are they actually making it, or are they just doing enough to keep going, to keep going, to keep going? And some of them are still at that stage of, will they make it? Sure. But there's also been some really successful ones.
Right. I guess, lots of people think they need money. And I guess it's true that we probably do all need money and capital to assist our businesses grow and develop over time. Why would a business really want to go to an investor as distinct from, say, borrowing money from a bank or something like that?
That's a really good question. Well, in some cases, they need money and the bank won't loan them. So for example, a startup, if you've got an idea for a great product, maybe it's software development or something, you've got no chance of getting money from the bank unless you've got a house, with a lot of equity in it or something, where effectively you're using that as security to get a loan, but it's not really a business loan. So often businesses are going for an investment because that's the only real viable way of raising money. Mm-hmm. That's not always necessarily the best outcome, because you really need to get an investor if an investor is the right thing for your business, but often there's no choice. People tend to go to banks, no. They may go to family, ask them, no. Then they look at an investor. But it's really a case of, why do I need, is it money that I need, or is it money and expertise? Is it experience? Often a business will get an investor because they actually want someone who's been there and done that. Yes. So it's money with experience as well.
That's a really interesting point, because money is relatively easy to get. I mean, it can be through a credit card, or it can be through family or a personal loan or whatever. Exactly. But oftentimes it is that expertise that is actually missing out of a business, which keeps a business from achieving the successes that it requires.
Yeah, so the way I look at it is, if I've got an amazing idea, and I found a gap in the marketplace, and I'm absolutely positive that I've got this brilliant idea. So, and I've got the skills to make that idea happen. But have I got the skills to turn that idea into a massively successful business when I've never done that before? So why don't I find someone who's got some skills, who can add some value, that's been there, done that, that knows how to make a success out of my great idea? So am I giving myself the best chance, or should I get people that have that specific knowledge and expertise beyond the great product, great idea? So often an investor can bring that experience to the business.
Okay. So what types of investors are there? I mean, it sounds that, you know, it sounds like, you know, with money, there's many different ways in which you can get money. It would seem that there's many different types of investors possibly that would be available to you. So what are some of the types of investors, and what do they actually look for?
Okay, well, in simple terms, we can really, I guess, divide the marketplace up into individuals and corporate. So within the corporate world, we've mostly got what you'd loosely call a venture capitalist. So VC is a firm that has raised money, usually from pension funds and things like that, and it's taken that money and then investing in a range of businesses. So that's what you've heard about, all the Silicon Valley VCs that got the whole, I guess, the tech boom going and all of that. We're all venture capitalists, effectively professional investment firms. So there are a whole range of corporate investors like that. The other type of corporate/business investment would be where a company invests in another company for a strategic reason. So they may invest in a supplier because the supplier's manufacturing a key component for their business or a key part of whatever they do. Then the other investor types are what I would call an individual investor, where again you can probably divide that up into a professional investor who's pretty much full-time, or pretty much that's what they do. And then you've got the one-off type of investor that might either buy into business for strategic reasons, for a family member, or maybe often it's somebody who's been very successful with their business and they've sold it, made quite a bit of money, maybe they're a bit bored, and then they think, well, now they can help some other businesses, so then they might look at investing.
Okay. Another element that I've heard of, and you know, you might want to explain if you would, is that what I've heard is the strategic investor?
Yep, so that would really be saying that business really interests me, or that business is helpful to my business, or so it could be an investment in an industry or an investment in a type of business to secure. It might be technology that they're interested in, so it might be some software that's been developed that another company looks at and says that software could be quite useful within my software. So if I buy a share of that company, I can get access to that technology and that knowledge and that know-how. I've come across areas where businesses have invested in another business because they want access to the IP of that person. In other words, they see a very smart person, and they think, well, a way I can get access to that talent is to invest into their business.
Is that the same sort of thing as where a business might, say, invest in a company that is part of their supply chain, so a delivery company or something like that, to reduce costs and to have greater control?
Yeah.
Okay, great. Obviously, with investing, it's a sort of, you know, it's a bit like Tats Lotto in some ways, I would imagine, in terms of, you know, I've heard people call it a bit like the gambling aspects of it. So there are certainly a lot spoken about the risks, both for and returns, both for the investor and for the organisation that is bringing an investor into their business. What sort of some of the issues that you can see around that, and what does this actually mean to both parties?
Well, basically, there's a direct relationship between risk and return. So if we look at the most basic concept of, if I took my money and put it in a NAB online savings account earning maybe 2.5% interest, it's a very low return, but there's pretty much no risk. Okay. The chances of me losing that money is so small, it would only happen if the banking system collapsed. And if the banking system collapsed, that would probably be the least of our problems. Yeah. So the chances are the risk is almost zero. That's a very small return. If I move up the risk and return effectively paradigm, the next more risky option maybe would be to put some of my money into a blue chip share in the stock exchange. Okay. So that might get me per annum maybe a 10 or 11 or 12% return. But there's a risk that the share price could drop and I could lose some of my money. Yeah. Alternatively, I could take a slightly higher risk. I could invest maybe in a slightly riskier share, maybe a startup gold mine or something, where I might get a much better than 10, 7, 8, 12% return, but the chances of failure are much higher. Once we move outside of the stock exchange, where the benefit of the stock exchange is the fact that the shares are traded publicly, which means it's relatively easy to buy them and relatively easy to sell them. We then move into private companies. So if I were to invest in a established, successful private company, I would want to get a return greater than if I'm investing in the stock exchange, because it might be really difficult to sell those shares. So my returns would be heading towards 20% as the minimum. Yep. If I invest in a new business that's sort of relatively established in the market but probably yet to be very successful, my risk is higher, I would expect a higher return. If I'm investing in a startup, I would be taking a much bigger risk, and I would therefore expect an even bigger return. So down at the bottom, I might want 2% for return for a very low risk investment such as a NAB savings account. At the other end, I might want a 30, 40% return on my money, because I'm taking such a huge risk that there could be a failure. So basically, different investors would have different risk profiles. So there are a lot of investors that say, I will not invest in a startup, not interested. No matter how good it is, no matter how fantastic the opportunity might be, I'm not interested. And that's because their risk profile is such.
So whilst they're the investor, but they're more risk averse.
Yeah. So there is a venture capital fund I know of in Melbourne that will only invest in established businesses. Okay. So they would not expect a 50% return on their investment every year, because they're looking for more certainty.
So what should the business owner be expecting out of this?
Well, generally speaking, the fact that you've started a business or you intend starting a business pretty much means you're a risk taker. Yeah. So from a perspective of the business owner, they're looking to get a return, obviously a high return, but that's part of the investment process, is to understand what the investor's looking for and understand what the business owner, the person selling, is looking for. Yep. So a good investor will ask the right questions as to what's success. Does the business person want to get a product into the marketplace and their success is the fact that it's a product that people use, or is the success for them that they take it to the world? Is success $1 million? Is success $100? Is success $1 billion? Sure. So generally speaking, obviously business owners are more risk takers, because that's how they landed up in business.
We were talking just then about the person who's going to have an investment into their business a little bit. What actually are the investors looking for?
That's a really, really difficult question to answer simply. Investors, I guess, investors are looking for very different things. I know investors invested in 4 or 5 businesses that I've helped find money, and he looks for people that he believes he can help. Okay. So he's looking to make a difference, where he thinks he can add some value with his experience, to add to the money. Other investors are looking for money. So just, I want to put $100 in and get $1,000 back one day. Yep. So it's really very much a case of finding out what the investor's looking for to make sure you've got a good match. So if you've got an investor that's looking to take a business that's based locally and take it to the world, but the business owner doesn't have that objective, that's really important to make sure they're...
So what we're saying is that the investor profiles are probably as diverse as the business profiles.
Absolutely.
And it's about finding that happy match.
Yeah, and also it can work on business type. So for example, one of the capital raisings I was involved in was elite sports related web-based product or service. And because it was sport, a lot of investors are just not interested. Okay. We actually attended a pitch that they did to a group of about 15 investors, and they started off the pitch by saying, do you pick up the newspaper and read and start at the back page with the sport, then go to the business section? I said, if that's the case, this is for you. And I was watching the room, about a third of the room just switched off. Yeah. The rest of the room were sitting forward in their seats because they loved the idea of investing in something related to sport. Okay. Whereas the other group just went, I'm not interested in sport.
Okay. Yeah. One of the things that I can see is that, you know, as a business owner, I can have the great idea and I'm very passionate about my idea. But my passion is not necessarily something that's going to woo you as an investor.
Exactly.
So I guess one of the core questions for, you know, that our viewers and listeners might like to know is what do they need to do to actually make their business idea attractive to an investor?
That's basically, I use a mnemonic called Mover. Uh-huh. And Mover is really the key points that you need to cover. So in positioning your business to get an investor, you'd usually do it through an information memorandum, which is like a business plan. Okay. And it, loosely, if you can cover in that the 5 words under Mover, that will help you attract an investor. So the M is for management, and it's probably the most critical one. So an investor is effectively investing in the business, in you, the owner, the manager, or the other management of the company. So it's critical that you show the investor that the business has the skills necessary to take that great idea and make it happen. Okay. So it's fine to have gaps in knowledge, lack of experience. So maybe we want to go to the world, we've never gone, we've never taken a product out of Australia. So it's okay to have a gap, but ultimately does management have the talent and the skill and the ability to learn to take that business and make it successful? Absolutely. So in reality is most investors are investing in the person.
Sure. And that sort of relates back to if that skill is not there, then this is where the investor may provide some of that expertise gap. Okay.
So that will be part of what will make investment successful. If the investor says, these people have not taken a product out of Australia, but I have. So I know what the challenges are and I know how to help the business get there. That's going to improve the likelihood of that being a successful investment. The other thing within that management is what I call the mad inventor syndrome. Okay. You also have to be careful that you're not so passionate about your idea that you don't actually want to let go of it and be successful, almost like giving away one of your children every time you sell something. Yeah. So part of that M for management is also showing that you have the understanding that your product or your idea is a good one, but that you can let go of it to make it successful. Okay. Okay. The O is for opportunity. Right. So what is the opportunity that your idea can fulfill? In other words, what is the market? Who's going to buy it? How much are they going to pay for it? How are you going to sell it? So it's, as one serial investor said, anyone can put numbers on a spreadsheet. Anyone can say we're going to sell 10, 12, 20, whatever. It's a case of how can you explain the opportunity and how you're going to achieve it. So what you don't want us to be saying is, the market is 25 million people. If we can get 1% of the market, then, we've made lots of money. Right. It's more about, in order to sell this product or this service, we will have to do 2 presentations per sale. 2 presentations will mean we'll have to make 25 phone calls. Right. So that means for every sale, we'll need 50 phone calls. Right. 50 phone calls are going to take us X number of hours. So it's thinking through the process and being able to show that the opportunity is there, but how you're going to achieve that opportunity and how.
So it's the action elements.
Yeah, it's the how. So number one, it's what is there. So the opportunity is to sell this product to every household in Australia.
Right.
There's X million households. So in order to do that, these are the steps that we're going to have. Then the opportunity might be outside of Australia. The markets in New Zealand and United Kingdom or whatever are similar. So it's what is the size of the opportunity and how are you going to achieve it. V is the valuation, and we'll probably talk more about that in more detail later.
Right.
But what is the business or the opportunity worth, and what money are you looking for? So if you're looking to raise $100,000 and your business is worth $200,000, well then you can only effectively expect to have half your business if you're going to raise that money.
Sure.
If your business is worth $1 million, then effectively you're selling 10%. So what is the business worth? And to be able to show an investor that their investment is going to buy them a certain percentage of the business and why that's a fair valuation. So the opportunity is connected to the valuation, because the bigger the opportunity, the more you can explain how you're going to achieve it, the easier it is to justify that valuation.
Okay. Yeah.
E is for exit. So
cool.
exit plan, very.
Yeah.
So most investors are looking to invest for 3 to 5 years maximum.
Right.
They want to know how they're going to make their money out at the end.
Right.
So saying, oh, well, one day maybe we can sell it, is not going to cut it.
It
So-
might be ideal for the business owner, but not for the investor.
Exactly.
Yeah.
So what we want to say is, we've identified these companies are ideal purchasers of our business if we can achieve these objectives.
Okay.
So we've got a telecommunications product. We can sell it to all businesses in Australia, and Telstra is a perfect company to buy that product one day.
Right.
So, and also the sorts of money that could be expected. So for example, one business raised capital, very compelling, was to say a similar business in this industry was able to sell for $10 million. We're in a slightly different area of the same industry, so the sorts of people that bought that business would probably want to buy our business if we're successful.
Okay.
And R is for return.
Right.
So that's to make sure that you can identify the return that an investor is going to get on their investment. So most investors are looking for a capital gain at the end and a return along the way. Now, they may not get that return for the first few years, especially if it's a startup, but they want to, so your numbers need to show how they're going to get a dividend or a return somewhere along the journey.
And I would imagine, Joss, this would all need to be formalised in
Yep.
some way.
In the information memorandum that I referred to.
Okay.
So it's like a business plan with a bit more.
Okay.
So it basically explains what the opportunity is, who you are, why you're going to be successful, what the business is going to be worth, with a cash flow and a budget to show the numbers, which proves the value, which basically covers off those 5 mover processes.
Okay. Great.
So getting an IM written is challenging.
Is there some sort of a template type thing that is available that can guide people? It won't be necessarily the exact follow these steps,
Well,
check the boxes.
no, exactly.
Because businesses will be different, I would imagine, and the needs of investors and the mix will be different. But is there a sort of a guiding template that?
The basic processes around a business plan, in terms of there's lots of guides for how to write a business plan.
Sure.
Those guides and templates are pretty good. But what you've then got to make sure is that you're covering off everything that's in the mover. The other thing is an IM needs to reflect the business owner.
Yes.
So I've not often seen success from people who have gone out and paid someone to write an IM for them.
That's a very interesting point.
Yeah, so there are people out there who are professionals at writing information memorandums. What I found when those have been written is that the investor then questions the business owner, who of course can't answer all the questions because they didn't write the document.
Okay.
And I tend to find that an investor wants to understand the people they're investing in. So it comes back to that M management. and therefore the business plan, the IM, needs to reflect the business. So if you're, an engineer and you make things and you design things, and writing beautiful documents in beautifully written words is not your forte, your IM shouldn't be written in beautiful English, because that's not who you are.
Yeah.
So if it's a slightly technical document, as long as it's clear and as long as you're covering off the points that we spoke about,
Right. Yeah.
then the investor understands who they're investing in. So if you've got a beautifully written document and then somebody invests in your business and 3 months later you write a report as to the state of the business, and the investor goes, hold on, this is awfully written.
Yep. Yeah. Yes, it's a bit like dating. You've got to be. It's better to be upfront than have some nasty surprises.
It is dating.
Yeah.
Exactly right.
Yeah. Okay. Look, I can imagine there's all sorts of different times when we think we know money, or think we need money, I should say, for our businesses, and sometimes that's when we're most often when we're in trouble. When is the right sort of time to go and find an investor?
There's no effectively right time. It's usually a case of understanding your business well and understanding what you need the money for. So when you raise money, if you get a whole lump of money, naturally you'll spend it. So you want to make sure that that money is being spent to take the business to the next level. So the right time is when you need it. The later you raise money, the better. Simply because if you've got an idea, especially, if you raise money at the very beginning when it's just an idea, the risks are higher than if you've actually finished your product and you need money to go to market. Or if you've launched the product and now you need money to take it to a wider audience, again, the valuation will always be higher, the risk will always be lower. On the other hand, maybe you can't develop the product until you get the money.
Right. It's interesting because, yeah, it does make sense to me, the fact that, if you've got some track record there, then you can provide more security, and I would guess you'd probably be more investors or potential investors would be willing to get involved with the business, assuming that it's the right style of business for them.
Correct. So each stage that the business goes from idea, so we're focusing on a startup, if you go from an idea to a product to release in the market to more mature, each step the risk is lower of failure, the valuation is higher, therefore you will sell less of your business. On the other hand, you might need that money else you couldn't have got there in the first place.
Okay. So what sort of types of investors should I be looking for? You were talking about different types of investors before, and we're talking about now about how do I go and find an investor? But what type of investor should I be looking for?
You've really got to look at the matching of what type of you to that person. So if you, for example, go to a VC and it's quite difficult to find, there's not a lot of startup VCs in Australia that will invest in startups, so often they'll end up going to America, to Silicon Valley. If you're getting a venture capitalist to invest in your business, you've got to understand that they'll take no prisoners.
Okay.
If they think your business will be better off without you running it, you won't be running it.
Okay.
So if you are the right person, of course you'll be. Now, it's not to say they're going to get rid of you and you're gone. What they'll do, in many cases, is put a CEO in to run that business, and you may be marginalised in your operational role. Of course, you'll still have your shares.
Yes.
So you've got to understand that could happen. On the other hand, if you find an investor you're buying their skill set to help you, so they're investing, it's someone you need to make sure you can work with them. So you've got to understand, it's like, as you said, like dating, you've got to make sure the right skills and the right match of people and personalities.
Yeah. I guess the only thing with the analogy of the dating is with dating you get to go out a few times before you get involved, rather than with an investor. It's probably a bit more cut and dried. So you've really got to present a really good case.
And once they've written that check out and you've banked the money,
Yeah.
They own a share of your business.
Yeah.
You can't turn around 3 weeks later and go, I've actually changed my mind.
Yes. Yeah. Okay. You mentioned before, once they pay the cheque to you, they own a share of your business. Raises the question in my mind about how do you actually value the business, and particularly you're talking about startups. I would imagine the valuations, and you've touched on this before, is slightly different between a startup and something that's a bit more established.
Yeah, it's
So how do you value it?
Startups are very, very difficult. So if you take an existing business, traditionally businesses sell for between, say, 2.5 to 4 or 5 times their profit before interest and tax. So it's known as EBIT. So basically, if you have a business, you're making $100,000 profit, that business is worth between $250,000 and $400,000 as a rule of thumb.
Okay.
There's a whole range of things that can push that value up or down, but in general.
Yep.
So if you have a business that's making 100,000, you want to raise 50,000, well, that's 100,000 times, say, 400,000, 50,000 means you're selling 400% of your business, so that's what, 12% or something. If you've got a startup, an idea, what's it worth?
I probably think it's worth a lot.
It's worth what someone will pay for it.
Yeah.
So generally speaking, it's the size of the market. It comes back to that mover. So, have you got a product that you're going to go door to door and sell in the streets around your office, which means your market is quite small, it's local.
Yes.
The upside is probably quite small. Do you have something that can go around the world where every person or every business in the world realistically could buy your product? So it's a case of really how you can convince someone that they can make a whole lot of money by investing in your business. So an idea is worth what you can explain it and what you can describe it. I've seen valuations where you look at the business and say, are you including your house in that? Because the valuation is so high that no one will ever invest in it because they're valuing that idea at $25-30 million.
Yes, yes.
So it's really a case of how, and also how easy it's going to be in terms of, is it a product that you can release in Australia and sell all over the world without leaving your office? Or do you have to set up an office all over the world and therefore your costs are way higher? So there's so many variables that go in. So it comes back to that document and if you can tell a good story.
I guess, what sort of money should I raise? What's going through my mind is, as you're talking, is that it's difficult to actually get, particularly startups, an idea of the potential returns because it's unfounded, it's unknown. I guess the temptation is to go and get as much money as you possibly can.
Yes.
But is that necessarily the right strategy?
No,
in terms
definitely not. There is a danger of a particular startup of doing what they call overscaling. So we need to raise money to develop some software and then we're going to take it to market and we're going to sell it. And in your numbers, the business has put in things such as support person. Yep. So you look at that and go, okay, so you're putting in a full-time support person on day 1. But according to your own numbers, you're going to sell 4 products in month 1 and 5 in month 2. And by month 12, you're selling 20 a month. So even if your optimistic plans are right, you've still only got 83 customers after 12 months. You've got a support person sitting there on day 1.
Yes.
Right, maybe you only need that support person on day 300 or day 700. So don't raise money for things that you might need.
Okay.
Raise money, because effectively the more money you raise, the more shares you're selling, the more you're diluting yourself. So look at what sort of money you need. The other thing is to be realistic and say we might need some more money later. And that's a really important aspect of choosing the right type of investors, because some investors will be comfortable with the knowledge that there will be more money later. Other investors will not be. So it's about making sure your plan is is effectively to say we need enough money with a little bit of buffer in case it takes longer, because it always does, in case sales are slower at the beginning, because they always are, but just to raise enough for a buffer to cover that, but not for a whole lot of potential costs that you probably won't need.
Is there some sort of ratio, Joss? I can't necessarily see an investor that's going to turn around and say to me, "Oh, look, you need 100. Well, here's 100." Is there some sort of ratio in terms of what the expectations of investors have of how much money I should have in the business compared to what they put in the business?
No, and that actually raises a really good point about how the investor views you as the starter, as the founder, or as the person running the business. Generally speaking, most of the startup businesses are raising money because they don't have any.
Okay.
So the expectation is, I've created an idea, I've put 1, 2, 3, 4, 5 years of my knowledge, resources, smarts, brain power in this idea. I'm going to do all the work, but I don't have money to take that, pay for the development, pay for the product, to get manufactured, whatever it is. So what I want is my idea and your money.
Okay. And that's quite an acceptable ratio for
the
potential
right type of investors, yeah.
Yeah.
And it comes down to the plan. If the plan shows that there's a realistic chance of making a lot of money out of it, then the investors will. I've seen a lot of startups find investment on a valuation of around $1 million for effectively a well thought out idea, well presented, with a great opportunity. And they've tended to raise $200,000, $300,000, $400,000, which means they're selling 20, 30, 40% of the business in return for that money. And I've seen countless examples of that work at around $1 million for the idea.
We're talking about startups here, and you're talking some sizable dollars, millions of dollars and things like that. What about for the smaller businesses, that may be only looking for 10 to 50 grand, those sorts of things? Do the same sort of rules apply to them?
Yep, principles are exactly the same.
Okay. And I guess it just comes down then to the types of investors that may be available who are willing to play in that smaller space?
Exactly, because if you think about someone investing $50,000, it's what is a successful outcome when you invest $50,000? Well, if you made $250,000 back, that would be outstanding. If it turned into one of these businesses that just went, another Google, whatever, and you got, $500,000 or $1 million, well, that would just be, amazing experience and very unlikely. If you invest 50 and you got back 100, that would be reasonably okay as well. So if you're investing 10, the chances are you're going to, at best get 40 back, 50. So it's about finding people with the right expectation. I know a number of investors that wouldn't invest less than probably 50,000 and, wouldn't want to get less than about 5% in a business. So it's really about finding the right type of people for the lower down that investment cycle you go, the less professional those investors will be, the less experienced they will be in investing. Right. And it's important that the investor understands their role as an investor.
Okay. It's within this investment and in investing, the game, I guess, for want of a better word, are there some sort of standard rules about, like what you would think returns would be and, what you should be giving away in terms of a business?
Well, my rule of thumb is always the same. Never more than 50%. 51% means that effectively the other person has control. Yep. So generally speaking, no more than 50. The other thing is, if you're raising biggish sums of money, hundreds of thousands, it's probably better to see if you can get a range of investors rather than one. Okay. That's got a lot of benefits in, number one, getting some good knowledge and some broad experience, and also to make sure that you don't have effectively one person with too much control and too much power. Okay. So having 4 investors with 50 each is probably way better than having one investor of 200,000.
Okay. Well, are there any impacts or issues that might come about having an investor involved in my business?
Yes, there are a lot. Mostly, if you choose the right investor, good.
Yep.
But you've got to understand the impact on your business can be very different. Long run, it's very good for you, but it can often be quite an adjustment. So typically you have a business that, if it's a successful business it's running, maybe you're running your business, you're not used to effectively accounting to anyone else. So you make decisions on the fly. Mm-hmm. You don't have formalised reporting systems maybe because you don't need it.
Yes.
Maybe you're monitoring your bank account, you know your sales, you know your debtors, the rest doesn't matter. Yep. Bring an investor in, it's different. You have to have some reporting structures. Investor will expect accounts, they'll expect budgets. Mm-hmm. You can't make decisions on the fly anymore, you have to talk to people. Okay. But those things in the long run make for a better business. So putting some form of corporatization around something, generally speaking, is better for the business. So it provides good information. If you're telling the investor what's happening in the business, that makes sure that you know what's happening in the business. So there's a lot of impacts, and especially business owners sometimes struggle because they're used to saying, it's my idea, this is what I'm going to do with it. And all of a sudden you've got someone saying, are you sure that's such a good idea? Now, of course, if you've got the right investor with the right knowledge and expertise, well, you want them to say that.
Yes. Yeah, I think it's always important, having worked with many businesses myself, to sometimes challenge those basic assumptions and things for them to grow. Yeah. But when you're bringing an investor in, if I'm hearing you correctly, you've got to be prepared in your own mind to be willing to be challenged.
Exactly. Yeah, I think the key thing to remember is investors coming in there buying shares in your business. So say you used to own 100% of the business, you now own 80%, they now own 20%. It is not your business anymore, right? You still own the most of it, but you now have a business partner. Yes. So it is exactly the same as if two of you came up with the idea and went into business together, albeit the shareholding differential may be different, yes, but the investors put their money in and they now own a share of that business. So it is now your, in the broader sense, business.
And so by default they have a say in what goes on in that business.
Not a say as in they're not in charge. Yes. It's part of the successful investment is making sure that everyone's role's defined. So you're still probably the CEO, you're probably still running the business. And you're not going to be checking with the investor every time you should I go for coffee now? But you're going to spend a sum of money outside of maybe the budget, that's the sort of thing that would be discussed. That's why it's good to have an agreed process by which the business is run. If it's board meetings, then you're meeting once a month, once a quarter, whatever, and you agree with the investor what information. So one company I've been involved in, every Friday, the CEO of the business sends a 6 or 7 line email to the investors and the board saying, we had a really good week, we sold 3 products, we did this, we did that, this was not so good, that we didn't get that, this is the bank balance, and that Friday afternoon email just keeps everyone up to date. Mm-hmm. And all he gets back is good job, well done, do you need any help on this? And keeping the investors informed also enables them to predict what's going to happen in terms of money. Because the last thing you want to do is suddenly say, we've got no money in the bank. Yes. Uh-oh, what do we do now? If you're keeping the investors informed because you've got that structure, well, the investor's looking going, I can see that the cash is burning up quite quickly. Within 3 to 4 months, we're going to have an issue, and then you can talk about it.
Yeah. Over the time, is it with people investing and people that you've seen invest, is it more or less common for those investors to want to get actively involved in the business, maybe at a board level or even involved in the operations of a business?
The most common is board level. Yep. So most investors that are investing in a lot of companies are basically saying, I want to be involved at a board level, but anything you need help, I'm available. That's the best investors.
Okay.
So that they leave the business owners, founders to run the business, but they're available to assist in literally anything. Whether it be, can you come with me to that meeting? Whether it be, what do you think about this? But most investors want to be at that level where they're available to help, but you don't want an investor giving you money, investing 20% of your business maybe, and then literally sitting on your back, on your shoulder, questioning everything you do.
Sure.
So it comes back to that, make sure you understand who you're getting. Important part of when you meet investors is not get too caught up in the fact that they've got a check, and do your research. Find out about them.
That's an interesting point, and that is that as much as the investor's going to research in you, it makes good sense for you to be researching in the investor.
Exactly, because you've got to make sure you get the right sort of person. I've had an example recently. A business was looking for money. They met a couple of investors, and the investors put a little group together, and they actually did a handshake deal. And then the guy that was leading the investment came back when they had the next meeting, and he moved the goalposts. He changed it.
Okay.
And at that point, the company paused. They did some asking around on the guy and discovered some people that had had a very, very negative experience with him. That he had invested in a business and had really done exactly what we were saying, come in and interfered with everything, and it ended very badly.
Okay.
So luckily, because they had this, he changed the goalpost slightly. Yes. They did the research, got told don't touch the guy with a barge pole.
Okay.
So they went back and said no thanks and withdrew the offer.
Yeah, makes
so
sense.
They should have done that research in the beginning.
Yes. Over your time, Joss, I'm sure, and I'm thinking back to the ratio you're talking about, there's always going to be a couple who succeed, a couple who fail, and most of them sort of flow along in the middle. Are there some really good and horror stories that you might be able to relate that can give our viewers and listeners an idea of what they might look out for as the warning bells?
Good stories, for example, company, I met somebody with a great idea. I'll probably keep these generic in terms of without specifying the company's the industry. Came up with a great idea for some software. The guy was a professional. He'd never worked in software, but found a gap in the marketplace. Yes. So I helped him put together his information memorandum. We got quotes to develop the software, found the developers. We targeted a couple of investors with huge knowledge in the specific area he wanted to move into. Got the first guy on board. Once you've got one investor, it's quite easy to find some more. Yes. Got a team, I think he got 5 investors. Okay. They all put in $50,000. Yep. He actually structured the deal so that each investor got one voting A-class share, so that the founder, myself, and 5 investors, so 7 people, all have one share, which gives them a seat on the board. Yes. And then the shareholding that the actual investors were getting and that the founder and everyone has are B-class shares, which is where the profits and the money goes. Okay. So what he wanted is he wanted all the investors to have, at board level, a say in the running of the business. Okay. But the investors were chosen well, yes. And quite often we sit at board meetings with, should we do this or should we do that? And the chairman usually says to him, Simon, it's your business. You've got the most to win, you've got the most to lose. So, everyone's given their opinions, but basically whatever you want to do, we'll back. Yep. So and the business is going really well. It's been around for about 3 or 4 years. Yep. Had to do a second capital raising. The investors literally just said, sure. Okay. And that's really been a successful one.
On the other side of the coin?
Most of I guess, the bad experiences have really been around failures to raise capital. Okay. When you come across businesses that, for whatever reason, can't. Usually it's because either the founder owner is too overvaluing their idea or their business too much. They're not prepared to go into the effort to explain how they're going to how they're going to be successful. It's almost like, my idea is so fantastic, you should just give me money.
Yes.
The other thing I found is complicated businesses tend to struggle to raise money compared to simple businesses. So if you can explain what you do, explain the opportunity quickly, that tends to get people's attention. When a business is difficult to explain, I think most investors are going, well, if I can't understand it, chances are the customers are not going to understand it. So I've yet to, I'm pleased to say, come across a disaster, but I have come across bad deals that have resulted in unhappy people. Yes. So for example, where I've got a kind of rule that I say, avoid investors who say things such as, you don't earn anything until I get my money back.
Okay.
My answer to that is, oh, so then will you be giving your shares back?
Yes.
If you're getting your money back for investment, then surely you give your shares back.
Yeah.
So it's investors who expect someone to work in a business full time for no money.
It's totally unrealistic.
Yeah. So, realistically, a person that's working in a particular startup that's got no income should earn a modest salary, enough to get by,
yes.
but they have to earn money.
Yes.
If you're working in a business for nothing, then you should be issued shares every month, because you are effectively funding the business.
Yes.
So where these things go wrong, it's usually because it wasn't well structured in the beginning. So when you get investors saying, well, I need my money back first,
yep.
Right, bad deal. I'll loan you the money, and I want to share in the business, but I'll loan you the money.
Yep.
Again, each person's got their role. If you're an investor, you're investing in the business, you're getting shares in the business. You get your money back when you sell the business.
Yes.
Or you get a return on your money through dividends and things like that. So where things have gone badly wrong, it's when the deal wasn't structured right in the first place. And usually it's because a person's been maybe too desperate to get money and they've accepted a deal that they shouldn't have got.
Okay, cool.
So I've seen businesses selling 50.1%.
Just in wrapping up, is there sort of one or two sort of key points that if I'm a business owner who's looking for potential investment into my business, are there one or just two key points of these are the things that you really must do, and maybe this is one of the things that you really mustn't do?
Okay. Must always take professional advice.
Okay.
Right. Probably the biggest mistake I made in my career was about nearly 20 years ago, with an opportunity to, with an idea. Two of us had the idea. We took it to a guy to invest in finance. We did a deal over at a coffee shop, signed it literally went to his office, printed it out and signed it at the coffee shop. And it wasn't a very good deal.
Okay.
We gave away 50.1% of our idea. And there were a whole lot of things in that deal that we shouldn't have done.
Okay.
It all turned out in the end okay, but
Yes.
it was more through people being reasonable and fair
Yep.
than anything.
Okay.
We should have got advice.
Okay.
We're two chartered accountants, we should have known better.
Yep.
We should have gone to a lawyer and said, is this a good deal?
Okay.
But the lure of the money.
Yep.
And so I think that's the key thing is always take advice.
Yes.
And really, it's critical to make sure that the investor is someone you can work with.
Okay. And it must not?
Must not? Yeah, I guess must not find someone who will give you money under conditions that are not good business practice. Like, must not ever do a deal with someone who says, I get my money back first, because then they do not understand their role as an investor.
So I guess what you're saying then is that it's best to do business with an investor rather than a loan shark.
Definitely.
Okay. My name's Anthony Turner. We've been speaking with Joss Milner, who's a chartered accountant with some strong experience, as you can see from the video and the discussion, in the area of raising capital and also startup businesses and helping them succeed. So Joss, thank you for your time today.
Thank you.